What if I told you that the home you bought for $400,000 is actually going to cost you closer to $800,000 by the time you're done paying for it? And what if I also told you that your bank knows this, has always known this, and has very little incentive to ever sit you down and explain it to you? That's exactly what we're diving into today. The uncomfortable truth about mortgage interest, and more importantly, the strategies that can save you tens of thousands of dollars and cut years off the time it takes to own your home free and clear. I'm Gabrielle, a chartered professional accountant and founder of a tax-specialized accounting firm. I'm also on my own journey to financial independence, and everything I share on this channel comes from real knowledge, real numbers, and a genuine desire to help you build a life where money works for you instead of against you. So if you've ever wondered whether there's a smarter way to handle your mortgage, there is, and I'm going to show you exactly what it looks like. Let's start at the very beginning, because before we can talk about solutions, we need to make sure we truly understand the problem. When most people go through the home buying process, they're focused on so many things at once: finding the right neighborhood, negotiating the price, getting approved by the bank, making sure the inspection goes well. By the time they're sitting at the closing table signing their mortgage documents, they're exhausted, they're excited, and honestly, they're just relieved it's almost over. The last thing most people are doing in that moment is carefully analyzing the long-term cost of the financing they just agreed to. And that is exactly the environment banks are counting on. Here's what rarely gets explained clearly. Your mortgage payment every single month is not just repaying the money you borrowed. It's doing two very different things at the same time. One portion goes toward the principal, that's the actual loan amount, the money you need to pay back to the bank because they lent it to you to buy your home. The other portion goes toward interest, and that's the fee the bank charges you for the privilege of borrowing their money. Now, here's the part that most people don't fully grasp until they actually sit down and look at the numbers. In the early years of your mortgage, the split between principal and interest is nowhere near equal. It is dramatically, almost shockingly skewed toward interest. In the beginning, you could be paying $1,600 or more in interest every single month, while only $400 or $500 of your payment actually reduces what you owe. You're paying a lot and making very little progress on the actual debt. That ratio does improve over time, but it takes years before the balance starts to shift meaningfully in your favor. Now let's talk about why this happens, because understanding the mechanics here is what makes everything else click. The interest you owe each month is calculated based on your remaining principal balance. So when your balance is high, which it obviously is right at the start of a 30-year mortgage, the interest charge is also high. As you gradually pay down the principal, the interest charge slowly decreases, but because the total monthly payment stays the same, more of it starts going to principal as the years go on. This system is called amortization, and while it does mean your mortgage eventually gets paid off, it also means the bank collects an enormous amount of interest from you in the process, particularly in those first several years when your balance is at its highest. The other factor that plays a huge role here is the amortization period itself, meaning the total length of time you have to pay off your mortgage. In Canada, the standard is 25 years. In the United States, it's typically 30 years. A longer amortization period gives you lower monthly payments, which makes homeownership more accessible and more affordable on a month-to-month basis. But it also means you are carrying that debt for a very long time, and interest is accumulating the entire time. The longer the amortization, the more total interest you pay. It really is that straightforward. Let's put some real numbers to this so it stops being abstract and starts feeling very, very real. Imagine you've taken out a $400,000 mortgage at an interest rate of 5% with a 30-year amortization period. Your fixed monthly payment works out to approximately $2,147. That number might feel manageable. It might even feel reasonable, depending on where you live and what the housing market looks like. But here's what that monthly payment actually adds up to over the full 30 years. You will make total payments of approximately $773,000. Out of that $773,000, exactly $400,000 goes toward repaying the principal, the money you actually borrowed. The remaining $373,000 goes entirely to interest. That is $373,000 paid to the bank for the cost of borrowing. That is nearly equal to the original purchase price of the home. You essentially bought the house twice. And this is assuming interest rates stay the same for the entire 30 years, which in many cases they don't, meaning the real number could actually be higher. I want you to really sit with that for a moment. $373,000 in interest. That's a vacation home. That's a child's education multiple times over. That's decades worth of retirement contributions. And for most people, it just quietly gets paid away month after month without them ever truly reckoning with how much it actually is in total. This is the number banks aren't putting on a billboard for you. This is the number that should fundamentally change the way you think about your mortgage. Now here's the good news, and this is really where the conversation gets exciting. You are not locked into this outcome. The 30-year payoff timeline and the $373,000 in interest are not inevitable. They represent what happens if you do nothing extra, if you just make the minimum payment every month for 3 decades and never think strategically about your mortgage. But there are specific, proven strategies that can dramatically reduce how much interest you pay and how long it takes you to become mortgage-free. And none of them require you to completely upend your financial life or make some extreme sacrifice. Let me walk you through all 3. The first strategy is the lump sum payment. This is exactly what it sounds like, taking a meaningful chunk of money and applying it directly to your mortgage principal all at once. This could be a tax refund, a work bonus, an inheritance, proceeds from selling something, or savings you've been building up over time. The key is that this money goes straight to the principal, which immediately reduces the balance the bank is calculating your interest on every single month going forward. In our example, let's say you're able to put down an extra $20,000 toward your $400,000 mortgage, bringing your remaining balance down to $380,000. You keep making the same fixed monthly payment of $2,147 as before, but now, because your balance is lower, more of each payment goes toward principal rather than interest right from the start. The compounding effect of this single decision is remarkable. You would pay off your mortgage in approximately 26.8 years instead of 30, and your total interest paid would drop from $373,000 down to around $310,000. That's a saving of over $62,000 from one single payment, one decision, one transfer of funds. And just like that, you've saved $62,000 and shaved more than 3 years off your mortgage. There is one important practical consideration with lump sum payments that you need to be aware of before you run to your bank. Most lenders have prepayment limits, restrictions on how much extra you're allowed to put toward your mortgage in a given year without incurring a penalty. A common limit is 20% of the original mortgage balance per year. On a $400,000 mortgage, that would be $80,000. So a $20,000 lump sum payment is well within that limit and completely penalty-free. But if you were thinking about putting down $100,000 or more, you'd want to check your mortgage agreement carefully before doing so, because exceeding that threshold could trigger a prepayment penalty that would eat into your savings. Always verify with your specific lender what your prepayment privileges are before making any large extra payment. The second strategy is making consistent extra monthly payments toward your principal. Now, this one might be the most surprising of the 3, because on the surface, it sounds less impressive than a big lump sum. We're talking about adding an extra $200 per month to your mortgage payment. That's it, $200. Less than a lot of people spend on subscriptions, takeout, or impulse shopping in a given month. But watch what happens when you actually run the numbers. Adding just $200 per month to your mortgage payment, applied directly to the principal, means you pay off your mortgage in approximately 24.8 years instead of 30, and your total interest paid drops to around $298,000 compared to $373,000 in the base case. That's a saving of roughly $74,000 in interest, more than the $62,000 you saved with the $20,000 lump sum. Let that land for a second. A consistent extra $200 a month outperforms a one-time $20,000 payment over the long run because it's compounding month after month, year after year, continuously reducing the principal that interest is being calculated on. This is the power of consistency in personal finance. Small, disciplined actions repeated over time produce results that feel almost disproportionate to the effort involved. If you can find $200 a month through a small lifestyle adjustment, a side income, redirecting a subscription you don't use, or simply being more intentional with your spending, you can save $74,000 over the life of your mortgage and be done paying it off more than 5 years ahead of schedule. There is one very important thing to get right when setting this up, though. You need to make absolutely sure that your extra payment is being applied to the principal only and not being split between principal and interest the way your regular payment is. Some banks, if not instructed otherwise, will simply apply the extra amount as a regular payment, which means a portion of it still goes to interest and you lose much of the benefit. Call your bank, log into your account, or check with your mortgage advisor to confirm that any additional payment you make is going directly and exclusively to your principal balance. This one step is critical to making the strategy work the way it should. The third strategy is switching from monthly to bi-weekly payments. This one is beautifully simple in concept and surprisingly powerful in practice. Instead of making one full mortgage payment every month, you split that payment in half and make a payment every 2 weeks. So instead of paying $2,147 once a month, you pay $1,073.50 every 2 weeks. At first glance, that might seem like it would be exactly the same thing, but here's where the math gets interesting. There are 52 weeks in a year. If you're making a payment every 2 weeks, that means you make 26 payments over the course of the year. 26 half payments is the same as 13 full payments, but if you were paying monthly, you'd only make 12 full payments. So by switching to bi-weekly, you're effectively making one extra full mortgage payment every single year without it ever really feeling like an extra sacrifice. It just quietly happens as a result of how the calendar works. That one extra payment per year applied consistently over the life of your mortgage adds up to something remarkable. In our example, switching to bi-weekly payments means you'd pay off your mortgage in about 25.2 years instead of 30, and your total interest paid would drop by approximately $68,500. You didn't change your budget. You didn't find extra money. You just changed the timing of your payments and let the math work in your favor. This is one of the most accessible strategies available because it genuinely doesn't require spending more. It just requires setting up your payments differently. Most banks will allow you to make this change easily, and once it's set up, it essentially runs on autopilot. Now let's zoom out and look at all three strategies side by side, because seeing them together reveals something really important. The lump sum payment of $20,000 saves you about $62,000 in interest and cuts roughly 3.2 years off your mortgage. The extra $200 per month saves you about $74,000 and cuts more than 5 years off. The biweekly payment switch saves you about $68,500 and cuts nearly 5 years off. All three are powerful, all three work, and while the extra monthly payment wins in this particular example, the best strategy for you personally depends entirely on your specific situation, your mortgage balance, your interest rate, your amortization period, and what kind of extra funds you realistically have access to. But here's what I really want you to think about. These strategies are not mutually exclusive. You don't have to pick one and ignore the others. Imagine doing all three simultaneously. You put your tax refund toward a lump sum payment every year. You find $200 to $300 per month in your budget to add to your principal. And you switch to bi-weekly payments so you're making that extra annual payment without even thinking about it. The combined effect of all three strategies working together would be extraordinary. You could potentially pay off a 30-year mortgage in 20 years or less, saving well over $100,000 in interest in the process. That is a life-changing outcome, and it's available to anyone who understands how the system works and decides to be intentional about it. There's also a deeper mindset shift worth talking about here. Most people think of their mortgage as a fixed, unavoidable cost, something that just exists in their financial life for the next 25 or 30 years, and there's nothing much to do about it except pay it every month and wait. But your mortgage is actually one of the most responsive financial instruments in your life. Every extra dollar you put toward the principal today saves you multiple dollars in interest over the years to come. The return on paying down your mortgage is guaranteed and immediate. It's literally your interest rate. In an environment where interest rates have climbed significantly in recent years, that guaranteed return becomes even more valuable. Think about what your life looks like on the other side of this. No mortgage payment. Not a smaller mortgage payment, no mortgage payment at all. For most households, the mortgage is the single largest monthly expense. Eliminating it doesn't just free up money, it fundamentally transforms your financial life. It means you can save more, invest more, give more, travel more, take risks you couldn't take before. It means if something happens with your job or your health, you have a dramatically different level of resilience than someone still carrying a full mortgage payment every month. Owning your home outright is one of the most powerful financial positions you can ever be in, and these three strategies are your roadmap to getting there years ahead of schedule. So here's your action plan coming out of this video. First, sit down and actually run your own numbers. Look at your current mortgage balance, your interest rate, your remaining amortization, and your monthly payment. Figure out how much total interest you're on track to pay if you do nothing differently. That number alone should motivate everything that follows. Second, identify which of these three strategies or which combination makes the most sense for your situation right now. Maybe you have a bonus coming. Maybe you can carve out an extra $150 or $200 a month. Maybe you can set up biweekly payments this week with a quick call to your bank. Third, take action before the moment passes. The biggest enemy of progress in personal finance isn't lack of knowledge, it's inertia. You now have the knowledge. Don't let it sit unused. Your mortgage doesn't have to define the next 30 years of your financial life. With the right strategies and a little bit of intentionality, you can take back control, save an enormous amount of money, and reach financial freedom far sooner than you ever thought possible. If this video helped you see your mortgage in a completely different way, please hit the thumbs up button. It genuinely helps this content reach more people who need to hear it. And if you haven't subscribed yet, now is a great time because we are closing in on 100,000 subscribers, and I would love for you to be part of that community. I'll see you in the next one.